Hello everyone, welcome to our Egyptian online seminar group. First, kick us off. Then, if you have any questions, you can ask our speaker after his presentation. I have great pleasure of welcoming dear Professor James Olson. James Olson is one of the top accounting thought leaders in the world. He is currently positioned is at Stockholm School of Economics as an affiliated researcher. Now we will start our seminar with dear Professor James Olson.
Okay, so thanks for having me and Happy New Year, everybody. It's January the 2nd, but it's almost January 1. So my understanding, just to make sure that we know the rules of engagement, is that I have an hour and a half in totality, but I plan, and it could be more, it could be less, at least 15 minutes at the tail end would be able for Q&A. However, having said that, if you want to ask questions during my presentation, feel free to do so, especially when it comes to clarifying issues. I hope it's going to be clear and so forth, but if you find that something seems to be missing or something needs to be clarified, just feel free to ask me and I will answer. I think that will work time-wise. I have a total number of, I think, 11 slides or something like that. And the paper is only, I think the paper is only 15 pages or so. But the content requires quite a bit of exposition in order to get internalized. It's a somewhat peculiar paper from a point of view that it doesn't really sort of have a punchline. Here is this, and this is what I want you to take away, and this is how we go about finding it. Instead, what I'm trying to do in this paper is to put the pieces together. And there's sort of 7 or 8 pieces, depending upon how you want to look at it. And the pieces are there to deal with the topic at hand, which is, of course, that when we think about equity valuation, the starting point has to be in terms of financial data. So the question is that the financial data has certain characteristics, and these are accounting characteristics. And because of accounting characteristics, we expect that equity valuation should embed these characteristics. So there got to be cohesion. Most of the time when you learn about equity valuation, we give you formulas like residual income valuation and PVD and whatever have you. And then it shows up in the textbook and then it shows up in the classroom. What I'm trying to do is a little bit more ambitious. I'm trying to say this is how accounting works. And because accounting works the way it works, we should expect that the equity valuation covers these concepts. So that's what I'm trying to do here. There are really no sort of mathematical difficulties. The contribution of the paper is that how you take the pieces and fit them together is not particularly straightforward. At least it hasn't been in my case. But once you know how to do it, it's not complicated. It's just a matter of making sure that you get the sequence of ideas correct, and then you move from there. So that's sort of what the paper is all about. Now, trying to be more specific here, so everything really revolves around the 4 letters here. P, equity value. Then we have earnings, dividends, and book value. So these are the key accounting numbers. And the symbols are just going to be straightforward. E is going to be earnings. D is going to be the dividends. It's actually net dividends. And then we have book value. So we take these things for granted. Now, when you move on, then we have to keep in mind certainly 2 things here. First of all, that when we talk about earnings, dividends, and book value, we have to make clear distinctions between current realizations, past realizations, and the expectations about the future. So we have E, D, B, past, current, and expected. So later on, we're going to introduce subscript. So that's sort of fairly straightforward. Then, of course, we're also going to take the clean surplus for granted. So we have a change in book value is equal to earnings minus dividends, which really should be dividends net of capital contributions. The P is always the current P. And then what we want to do is to bring out all sorts of intuition. We're going to take PVED and the discount factor R as a given. This is not totally happy. And in an extended version of this paper, which I never finished, you can actually ask the question, which is quite sophisticated, is that if you cannot take PVEDR as a given, how does the analysis actually work? It can be done, but the degree of sophistication escalates quite a bit. But it's sort of a strange phenomenon. It's worthwhile to point out, and we can come back to that. Why do we take PVED for given? But that's what happens in all textbooks and all classrooms and all formal analysis. But it really should be avoided. Long history, of course. All right. So far, so good, I hope. Then we have to elaborate on the accounting concepts here. Let me then do this here. So this is very straightforward and somewhat vague, but I think we can relate to this here. The first thing is that E really represents in accounting wealth creation. And wealth creation is somewhat peculiar from the point of view that when we try to measure wealth creation, in the back of our heads and in all procedures, we have idea that earnings beget more earnings. So that has a long history in accounting and financial analysis. Of course, it's the essence of Graham and Dodd and all of these things is that we look for permanent earnings and whatever have you. And then we have D, which is the wealth distribution. That's the net dividends. And I put in positive or negative here just to remind you that we have capital contributions. But in the analysis, I don't make any distinction between it. But you just think about negative D as being capital contribution. And then we also know, of course, I think this sort of shows up even in elementary accounting, that D is very peculiar from a dividends. It's a little bit peculiar from a point of view that if you distribute wealth, it's going to have an impact upon subsequent wealth creation. In other words, if you credit cash, then that's going to hurt future expected earnings. But also, and this is going to be very important, dividends do not impact current earnings. So the idea is that when we have a 1231 transactions in dividends, then it doesn't impact upon the measurement of current earnings. So this is going to be crucial, and this is very commonly in error in finance and economics. And that leads to something which is very central in this exposition, what we call M&M and dividend policy irrelevance. So we're going to later on have to deal with the problem that dividends paid today have an impact upon the current stock price, but dividends paid in the future, the dividend policy does not impact upon the current price. Then we have a book value, and that's often referred to as net worth. I like that. When we talk about book value, basic accounting, one sort of gets the feeling, it should relate to market value. So we have idea that E, D, B are all sort of nice things. We like high E, we like high E, we like high D, we like high B, but they're quite different. Book value is really peculiar in some other aspects here. And this is part of the difficulty in the whole exposition and in the paper in terms of its sophistication, not in terms of mathematical difficulties. First thing, which you all are familiar with, is that we tend to think about book value as being conservative. So throughout the analysis, we want to keep in mind that P and B have a connection, but on average, we're going to have that the book value is less than the price. So that's sort of the norm. It doesn't have to be true all the time, but this is what we expect, and it's an empirical fact, blah, blah, blah. And then we have also the P equal to B. That's what we refer to mark-to-market accounting. No surprise. We have now the next thing is that, which is sort of an extension of this here, is that when we learn accounting, we get to learn about that B is a means to an end, the measurement of earnings. And that goes via clean surplus. So when we measure, one can think about, which is sort of traditional transactions accounting, one can think about asset and liability valuation is a means to an end of measuring earnings, and that's a clean surplus in action. But then there's also the idea that somehow that the current B is going to be an indicator of future E. So this is very tricky. But it should have some kind of connection. And that should show up in our analysis of equity valuation. And this is very sophisticated, actually. And we're going to get to that. And so the book value is sort of a nice thing. We like high book value. But when we teach accounting in FSA, we also come to recognize that B is a peculiar thing from a point of view that many of these operating assets build in future expenses and revenues. So we have the cost of goods sold depends upon the inventory, and property, plant, and equipment gives you future depreciation expense. So that's sort of a B. It's sort of kind of peculiar, and it's very different from D and E. And then we get some key ratios. It shows up in the classroom, it shows up in the real world, and it should show up conceptually too when we go through the analysis. We have the forward EP, which you're all familiar with. Often it comes as forward P, of course. We have the BP ratio, the market to book ratio, or book to market ratio. We have the earnings yield ratio, and we have also finally the ET plus 1 BBT, and that would be the ROE kind of thing, forward ROE profitability. So that's sort of the balls we have to juggle. This is what we have to pick up on. And as we move forward and we get to equity valuation and related an FSA, this is what we have to show. There's a manifestation of this. And that's the difficulty, because to get any conclusions, we are going to have to make the assumptions. So the difficulty is, how do we set things up in a formal way to pick up on this so we get something that's sensible and can be used conceptually and so forth. I'm not trying to give you a roadmap to how to make a killing or some very, very clever things. I'm just trying to give you a roadmap, but these are the balls you have to juggle. And ultimately what you want to do is to convince people, audiences, that this connects with equity valuation in practice. So we have to teach it. So you can do much more here. Some of it is discussed in the paper, but that's sort of a general background. Now, where should we head here? So let's see, how do we want to proceed here? How am I doing? Yeah. And the first thing of just is a simple recognition that investors like earnings and presumably like dividends, and we like book values. But when you look at this, earnings is sort of, bear with me here. The one thing we learned very quickly is that earnings sort of is more important. So the book value is more of a mixed message. It's sort of a little bit like market to book. You know, we want to book to market. We want it to be high, but then we worry about that. Dividends, then we get into the very peculiar thing. Yes, we like dividends. Of course we like dividends. But on the other hand, we quickly learn about the PVD, that the present value expected dividends is sort of the dividend policy, zero NPV thing. So we will get into this M&M thing here. The one thing which is worthwhile to mention here, folks, is the sophistication that are embedded being accountants. Contrary to economists and many finance people, and I remember this from my youth, earnings do not have a time value. We do not take the present value of expected earnings. That's quite remarkable. And there's no difficulty in finding finance and economics paper. They struggle with this because they know the time value of money. They know about the PV, they know about the M&M and stuff like that. And they know that earnings are important, but we don't quite know what to do with it. So then they finesse it by cash flows and whatever have you. But this is a very important thing. We have to deal with this fact. Okay. And the thing is that we also want to do to keep in mind that what we want to do is things that are consistent with how people think. Subject to this here. So indeed, make no mistake here that EDB, earnings, dividends, book values, they are very, very, very distinct concepts, as well as very distinct financial statistics in the real world. Excuse me. But we want to keep in mind here that somewhere along the line, if you're an accountant and you pay attention to the real world, the centrality of expected earnings is undeniable. Don't worry what some textbooks in finance tell you, and let alone you see economics papers and so forth. They write about the theory of a firm without talking about earnings and so forth. In the real world, and this you could view this as a postulate, the key thing centers around expected earnings. So that should show up in our analysis. I hope I'm clear. If we want to develop equity valuation as it relates to financial statements, somewhere along the line, the centrality of expected earnings have to show up, and it has to be maintained. And then you have DMB that lurks in the background. So we still have to deal with RD, and we still have to deal with RB. Now let's go. Bear with me, my throat. All right. What the textbook say? All right. I don't know how fast to run this. Most people know about this, but it's sort of peculiar. So everybody learns about Gordon Williams. That's in every textbook, finance, accounting, FSA, and whatever have you. And then they come up with the forward P is equal to KR minus G. So it's the payout, the discount factor, and the growth rate. So everybody knows how to do this, constant growth and so on. So this now, but when you do this, it's sort of disappointing. And why is it so disappointing? Well, there's really no concept of earnings. We sort of put in earnings in the back door. We take the present value of dividends, and then we rescale it and so forth. And it had a big impact upon me. So I'm going to tell you one story from my long history in accounting and as an academic. It's only one. But way, way, way back, this is a good story. Many, many, many years ago, we were in the faculty. I was in the faculty room at UC Berkeley, and I was there with some finance professors. And then the question came up here: what do we teach, or what do you guys teach in introductory finance the first few weeks? So it comes up. Well, you teach present value of expected dividends, and then they said that also you have to really learn about the relevance of M&M. M&M was quite big then, of course. So you teach PVD and you teach M&M. And then my colleague and friend, Mark Rubenstein, he said then, well, when you teach this, keep in mind, you need at least 1 week in between. In other words, if you want to deal with M&M, and M&M dividend policy relevance is central, then to start out assuming that they're just proportional with the fixed K, it sort of seems defeatist. So there's no concept of earnings, let alone the book value. Where's the book value when you do Gordon Williams? So this is a very tricky matter. How do we introduce book value? In Gordon Williams, we don't do it at all. Most finance textbooks cannot deal with book value for sure. and they have difficulty introducing earnings. So this is quite noteworthy. And that's why, in some sense, this paper is worthwhile, in my mind, because we sort of have to recognize the importance of Gordon-Williams, and yet we have to also then quickly learn it doesn't seem to be okay. There's something missing here. So then people, you find that maybe the forward EP should be 1 over R. Okay, so this is quite common. You find that, oh, the benchmark for a forward PE is 1 over R. And you see that in many textbooks. And does that make sense to you? Is that a good benchmark? The answer is, once you understand it, the answer is no. And furthermore, it is not true empirically that this is a good benchmark. So keep that in mind here. We have our work cut out for ourselves. So I'd like to answer that here. Well, then you have this alternative. Maybe it should be minus 1 R minus G. It doesn't work either once you start to look at it. And it sort of seems odd. R minus G. And suddenly, somewhere along the line, people actually learn the idea that the growth rate should probably tie in with the payout ratio. If you pay out a lot of dividends, you're not going to have that much growth. Maybe we have to deal with that. We have to deal with that. And yet, then, so that means that if the payout ratio is irrelevant, M&M in action, but the payout ratio affects G, how can that be reconciled? So that's very, very tricky. And there are solutions, and we'll get to them. But that, in my mind, is a key issue for everybody that teaches equity valuation. You have to come to grips with what is the forward PE all about, and how does that reconcile with the payout ratio, if you have a fixed payout ratio. So this is very tricky, actually. And that's why I told you this story, because it's sort of been bugging me over the years. It's really how people neglect it. Okay, but we have to keep it constant. But with a constant forward PE is actually a good benchmark. So here's the deal, folks. We want to come to grips with a constant forward PE as a benchmark, but we have to avoid the Gordon-Williams. And so the same thing here is with the PVD. So that's sort of, we have to start over. So that's what I'm going to do. So here we're starting over here. Now you have to be patient with me. We're going to leave out the book value for the time being. But we need something basic here. So this is, man, my voice here. So this is what we're going to do now here. So this is proposition 1 here. Assume PVD, and then we have this dynamic equation. It looks like a savings account almost, and C is just a parameter, and then we have constant PE. So it turns out that any two of these assumptions imply the first. It's a completed theory. And this is replacement of Gordon-Williams. So if you have this I and 2I, then you get this dynamic. So that's what it is here. Now notice something, folks. Pay attention. Do I make any assumption about the payout here? No, I do not. There is no assumptions about the payout. It's just a regularity condition. So if I have this dynamic, then I get the constant forward P. So we're going to have to deal with what is C all about. We get to it, you see. We get to it. So here, this is a replacement of Gordon-Williams. So if I may say so, to the extent there's anything worthwhile here for all of you, if you haven't seen this, the rest of the paper, in some sense, I'd like to think it's worthwhile, but this is definitely worthwhile. So there's no equation for dt plus 1 here. So it's just whatever payout is here. Now you notice is what's really going on here is that if you pay dividends next year, it has no impact upon next year's expected dividends. Dividends at t plus 1, t plus 2 has no impact upon here. So M&M applies. You can actually do it directly. And then, of course, if C here, it's worthwhile, I mentioned this quickly, is equal to R, then you get the mathematics of a savings account, which is actually quite sophisticated, but some people actually know it. Okay. But we need to say something about C here. Now I have a quick remark too. Excuse me. So a quick remark here. If you read M&M, I don't want to elaborate upon this. The paper, this is the Nobel Prize winning paper, 1961. It's actually in mathematical error. It's an outright error, and you can actually see how they struggle. And I have a note here, and you can look up at it. All I'm saying here is I'm a little bit proud of this. This is what you want to know about dividend policy relevancy and earnings. This is the starting point. But it's not good enough because we don't have anything about book value. And that's what the rest of the talk is going to be all about here. It's a slow process, but we will get there. So we can also allow for risk and whatever have you. So any questions so far? In other words, what I'm trying to do here is just introduce dividend policy relevancy and the centrality of earnings. And the starting point, when you think about the starting point, it's a pure replacement of the paper which are outright in, it's outright in error. It's the Nobel Prize winning 1961 M&M paper. So that's what that's what I like to think should be a very good takeaway. All right. So we don't have to worry about Gordon Williams. All right, so here's actually a comment as to what's wrong in M&M, but it's sort of a fun paper to read from a point of view that you can actually see they know they are in trouble, and they really, really, really struggle to get it. But they have to cheat a little bit. But in those days, you would not complain about the paper. Okay, now the C parameter here, should it not depend? So you could argue now, but here, folks, listen, it's down to earth. The forward EP, if you have a benchmark, should it not depend upon the accounting? The answer is yes. And everybody to some extent knows that if you have conservative accounting, then the multiple has to adjust. So the forward EP, we know that if you have very conservative accounting, do not get surprised if the forward P is very high. Okay, in other words, the C is quite small. So now what we want to do here is that the benchmark is a benchmark. In the real world, anything can happen. But when we develop theory, we need benchmarks. So that's sort of what we're going to do here. And the benchmark here is going to be what happens in the steady state. So now you know just what happens next is that what we're going to do is to assume that the EBDP will have the same growth rate. Suppose you have an environment where the expected growth in all of these four variables are all the same. Then what happens? Now it turns out that I've learned more about this. The steady state assumptions are extremely popular in ecology, population models and engineering models and whatever have you. And they also show up in economics and so forth. And so it's not something I'm inventing. It's a recognition that to get order in a very complicated world, and we have to juggle many variables, then we might want to check out what happens if you have a steady state. So it turns out that the EBDB and so forth, all of this is very consistent with clean surplus and so forth. And you can find it in the accounting literature. But I just want to make it clear to you that I'm not really inventing this steady state concept. I'm just using it. And the reason is very simple here is that we have to have an understanding what happens sort of like a benchmark. So the steady state is sort of like an average. It's very popular, of course, in ecology. Okay. And this leads to the well-known equation. So this is very well known here. You find it in textbooks. Well, it's not well known, but it's known for sure. ROE times 1 minus K. So we're going to have a fixed payout if we have in the steady state, and that's the growth rate. And then we have K as the payout here. So ROE times 1 minus K is equal to the growth in E, equal to the growth in D, equal to the growth in B, and equal to growth in P. So we can do this here. So now once you have this in place here, how am I doing here? Oh, man. How much time have I used? Oh, half an hour, I think. Am I right? Okay. Am I right? Half an hour? Okay. So now we get this can be derived now here. And I like this expression. I don't know about you. It is that the 40p is equal to a weighted average of BP and, I'm sorry, it's a weighted average of R, the discount factor, and DP. And the weight you put on it is the market to book, the book to market. So this is a very good expression. You can put in numbers there. They work quite nicely. You'd be surprised. You can improve on them, of course. But if you put in BP is equal to 1/2, R is equal to 8-9%, the yield is 3-4%, the forward EP, you get something reasonable. I would say for 80% of all companies, you get something reasonable. And then we arrive at the conclusion, and this is quite remarkable, that the C is now less than R if and only if we have conservative accounting. So you notice what we're doing now here. We're introducing the book value for purposes of figuring out the role of conservative accounting. Keep in mind, book value have roles as impacting the measurement of earnings, and then we get to how it connects with future earnings. And then we also find out, and this works empirically, if you use this in a steady state, ROE is greater than R is greater than EP is greater than DP. And I would say that for 80% of all firms, this is sort of roughly true. You don't know quite what R is, but when you play around with it. So when I'm trying to tell you, these inequalities are empirically reasonable. Am I clear? So the assumptions are really just that you have a steady state. You don't really need the fixed payout ratio. You don't really need the proposition there. It's still true. So you can think about earnings measurement using accrual accounting is a weighted average of cash accounting and market to book. So DP is cash accounting earnings per price ratio. And if the R is really the market to book, if you have mark to market accounting. So that's sort of the getting some structure to where we're heading. But we have still to deal with B in valuation. Am I clear? Any questions so far? Because this is sort of the key ingredient. I'm really sorry about this here. So we end up with a question mark here. What about B? We have introduced conservative accounting. And we have connected conservative accounting, the book to market ratio, that it has to connect with the forward EP, which it does empirically, no question. But we haven't said anything about B as something we like. So we like B, if you in some sense fix the conservative accounting. Why do we like B? Well, we get into the ROE concept. Of course, ROE is going to be biased by conservative accounting. But we also have the idea that, yeah, but if you control for the payout ratio and whatever have you, the more B we have, the more earnings we should have. So that's where we're standing. Any questions here? So the math here is not difficult. It's not hard to derive this if you know what you're doing, but most people can do it. And just again, for the sake of art, just for to emphasize this, that the steady state concept is an absolute standard concept all over the place. What's the name of this French economist who wrote the famous book about capitalism? He also uses steady state. Anyhow, any questions about here? So conceptually grounded valuation, this is what we need to consider. And moreover, now we get down to it. Somewhere along the line, a conceptually grounded valuation should be based on the idea that we use EDB to forecast expected earnings. That's ultimately where we're heading. Does that make sense to all of you? That's what we need to do. That's the name of the game of the paper. So let's keep the steady state equation. And now we get down to the fact here that oops. Is this right? Yeah, so we assume that this should actually DP. I think this is wrong here. Assume I don't think we should have this one. Just assume that this is true here. It's I can't remember what I do here. I think this is wrong here. So with these two assumptions here, what we want to do now, we can actually derive the RIV formula. So we have this equation here, the red one here. Actually, I'm sorry, this should be dP is R minus G. Okay, let me put this in here. I leave it like this. So the dP here should be R minus G. If this is true, then now we can derive RIV. Okay, so the point is as follows. Let me make sure that this comes across. This is a critical insight. RIV has the virtue that it can be made entirely consistent with the steady state in growth assumption. And that's when the dP is equal to R minus G. You have R minus G here, and that has to be equal to dP. If you put this in dP here, if you replace R minus G with D divided by P, or before the yield ratio, then you end up with this, and conversion. So, where are we heading? We are trying to introduce book value into valuation via RIV, which you will know. And make sure that in order to do that, RIV has to be consistent with steady state. Once we get that model exploited, then we can later on relax the RIV assumption, and then we're going to be done. Am I clear? Okay. Let me repeat that. We have steady state, and the steady state means that the 4dP is going to be the weighted average between R, in other words, the discount factor and the dividend yield. And the weight is going to be the degree of conservative accounting. So we have this here, and if you now add the assumption that the dividend yield is equal to R minus G, which sort of makes sense, right? Dividend yield. You have a lot of dividends when you have that you have to adjust for G here.
James,
Yeah.
question from Professor Pool.
So that's
Jim,
the steady state.
Jim, can you hear me?
Yes, I can hear.
A former colleague, Paul Zarowin. How are you doing? Great to hear you.
Oh, hi, Paul. How are you doing? Yeah.
Quick question. When you talk about risk, does it matter what type of risk you're talking about, whether it's covariance or whatever, or is it
No,
independent?
it doesn't. It's just that it's taken as fixed.
Okay. Okay.
So we have a discount factor. And what I said earlier, you really somewhere along the line you can remove PVED. But I mean, that's beyond what we can do today. It's quite
Okay.
complicated. But it doesn't have any, that's a good question. In other words, the R is a discount factor, and that's it.
Oh, okay. Okay.
Anyhow, excuse me. So the key thing from your point of view now is that you realize I'm introducing RIB, and I like to introduce RIB for the simple reason that it's entirely consistent with the steady state growth assumption. So it's actually consistent even with Gordon Williams. Okay. But so the steady, so it's sort of it's RIB now. Lurking in the background is that you have to have a fixed payout. Later on, you can remove all of these things. Now, so now you get and now it turns out here, and this is almost painful, because you all do RIB. Excuse me. My throat is really bad. Okay, so here it turns out now that the RIB, this is residual income, it can be restated as what? Have you seen this expression? Have you seen this expression? P is equal to a weighted average of book value and expected earnings. But the weight here is going to be negative, and the weight is GR minus G. This is negative. And this is expected, the green here is expected earnings. Okay, T plus 1. Have you seen this? Yes? No? This is RIB. RIB impresses people. But simplicity is always a virtue. So if you have this expression here, just rewrite it as this. And then you have the W there. So it's R minus G. Now, ultimately, then R minus G may be P. But this one here derives from this one without any reference to the steady state condition. So, being an academic, simplicity is a virtue. This may be good for other purposes, but notice here, I don't have to talk about the present value of residual income. Please note. I'm just saying, assume a steady state. Then you get this expression, which is sort of intermediate, because what you really care about is this expression. And that means that the price is the weighted average of these things. Now you notice one thing. The weight on book value is negative. So for any given fixed expected earnings, the less you have in book value, the more valuable is the company. Does that work empirically? Check it out. The answer is yes. And why is this? It's sort of because you're controlling for expected earnings. So I'm controlling for expected earnings. The more I have in book value, it doesn't seem to be too nice. It's going to be expensed. So that's actually what happens. So if you apply this, for example, now to today's market with the Magnificent Seven and so forth, it works quite nicely. All right, so you can calculate the PE ratio, the forward PE. Man, I really have to apologize here. All right. Any questions about this? Are you okay? All right. So this is expected earnings here. So you have to digest this. We're getting there. So the trick I'm engaging here, it's a little bit like when everything is said and done. Oh, Jim is going to use rib. Yes, I'm going to use the rib. But the only reason I can use rib is because it's consistent with a steady state. So I combine this thing here with constant growth rates. I'm in business. Okay. So beside two, you can use this here. And what you arrive at the following thing is that if you go back and do Ball and Brown, if you control Ball and Brown for the change in expected earnings, then the more you have in current earnings, the lower is the return. Realized earnings. The problem with realized earnings is that after you control for the expectations, earnings are going to have an impact upon the income statement negatively. So that's what we pick up on. So here I have then, after having control for expected earning, capitalized by R, the less the B, the more valuable the equity. This is the second thing I want you to learn from my talk today. The first one is the proposition. This is the second thing here. There's no drama to it. But I mean, what makes it a little bit interesting, it actually means that Ball and Brown is a little bit misleading because they don't control for a change in expected earnings. If they did that, they would find out that the realized earnings have a negative impact upon returns. So there's no drama here. You can just do the math, blah, blah, blah. And so maybe one day that will happen. But the thing is that I don't think so, because it's 50 years too late. So this is what I want you to keep in mind here. And those of your accountants are not shocked. The book value has expected benefits. So you see, but the key thing is what do expected earnings depend upon? They depend upon book value. If that's true, then of course it follows. But it also implies future expenses, which is negative growth as you move forward. So that's so far so good. And I hope now that if I'm communicating effectively, I hope now that you internalize the ideas and that you keep firmly in mind here that there are no secret math here. There's nothing very clever going on, but you have to juggle the balls carefully. And we have 4 balls. E, B, D, P, and we got to juggle these 4 balls, make sure that we can always collect them. And there are certain things we expect to happen here. So what I'm trying to do now at this point is just to emphasize, if you look at RIB properly, do not be surprised that book value has a negative impact upon current market value, negative impact. If you control for expected earnings, you can check it empirically. You can check it.
Is it Jim? Question?
Yeah. Sorry? Question?
Yes.
Any question here? I heard some voice. You okay? Okay. So I'm sort of going slowly here. I think I'm doing okay here. For the very simple reason that the name of the game is to just keep tab of ideas, and then we move slowly from a point of view of mathematics. So that's what we have now. What is going to come up next now? So these are observations here now. So we summarize. Now we have a special case here, and I'm sort of old, so I like simple things. Lots of sense here. So I love this one here. If this is a special case here and you can play around with it because it makes empirical sense. make G half of R. It's a steady state concept. Don't think about G as being growth in residual income and sales and whatever have you. That's the wrong way of looking at it. Just think about G as sort of a proportion of R. It's sort of a little bit like related to the payout ratio. So suppose G is half of R, then you get that PT is equal to minus book value times 2 times R expected earnings. And it's a wonderful expression because once you get going on it, you can play around with it. And yes, it works. Sort of. It works, sort of. Pick a stock at random. So you take it so it's twice here. And then you get here that the expected earnings divided by the average of price and book value, that's going to be equal to R. So it's a wonderful expression. Expected earnings divided by P is less than R. Expected value divided by book value is greater than R. How can we juggle the data so we get somewhere in between? This is the expression. So I like it, so I put it up here. And you can actually also show that when you think about this, M&M applies. So in other words, if you pay out more in dividends, it's going to have an impact upon future expected earnings, and it's going to exactly offset, so the price is going to be the same. So it sort of really is a very nice illustration. You'll be able to, M&M applies, the dollar dividends reduces P, right? The dollar current dividends reduces P by $1, and this is true here. Did I get this right? By R, yeah. I think I have, it's not sufficiently clear here. Okay, so, but anyhow, if you want to play around, my message to you, if you teach RIB, next time, why don't you play around and show the students what happens if G is equal to half R? Let me repeat that. It's sort of a benchmark. You have a steady state, and now you have G is half R, which is quite reasonable, actually. It's actually quite good. In a steady state, that's what happens. And then you put this in here, and this is what you get here. All right. Questions? All right. Now we get equilibrium valuation. I'm actually holding up there, I think, yeah. Okay. Now you notice, folks, what we have is that basically I assume that RIB determines P in a steady state. That's what I've done. And if I do that, I have dividend policy relevance. It's sort of very nice. And now what we can do is to use, it's sort of a little bit peculiar. Now we can use for proposition, you see. And now you notice is that I have introduced book value. Not necessarily what you expected because it has a negative weight. But you see, what I can do is to go back to the proposition and look at it from a purely mathematical point of view, in which case I replace capitalized earnings with RIB. Am I clear? First, I have a proposition without book value. That gives me M&M and a constant earnings price ratio. Now I'm saying I'm a little bit more sophisticated here. It's not that expected earnings alone determine the price. It's expected earnings, capitalized, adjusted for the book value. That's what determines price. When I put that in proposition 1, it's like putting C equal to 1, and I just put this in. And then I get equity valuation in terms of what? E, B, D. So proposition 1, purely mathematical, meshes and can be integrated with RIB. PT is equal to RIB. And once I get that, I get the equilibrium valuation beyond RIB. And that means that I also get the valuations here. So now I have PVED, and then I have, this is just a replacement. So I'm not using just ED. I have, this is sort of RIB, and this is RIB before you apply the expectation. And that's what you have here now on the right-hand side. So it's sort of mechanical. And then I have the valuation. This is RIB. 3i here is RIB. This is the dynamics of RIB. So it's for 2i. And where does this dynamics comes? It comes from RIB plus PVED gives me 2i. Am I clear? Present value of expected dividends. If you combine that with RIB, this is RIB in its unvarnished form. If you take this and you take PVED, this is the dynamics you end up with. That's what I do. It's housekeeping, but there's nothing complicated. There are too many symbols here, but it's totally straightforward. Go back to preposition 1, bam, bam, bam. Now, I used to have W equal to 0. That's proposition 1. W is equal to 0. And Z is equal to whatever. But now we're going to have W here. So it's consistent with RIB. Okay. So W now is going to be negative, and that we can put in here, and then we get the dynamics. And 3i, note here, 3i is equal to RIB. Where this is true. That's just the weight. So that's what it is. And again, you can put in G is equal to half R, and it becomes even simpler. Okay, nota bene about 2i RIB plus RIB leads to I. So 2i here, and so if you look at this, looks very complicated, and 3i is okay. Well, guess what? RIB is implied. So the present value of expected dividends is never, ever abandoned. It can be used as a muscle, an assumption, or it can be used to extract and it also becomes a conclusion. So this, in some sense, is the key theorem here, but it's really just proposition 1. But again, I keep repeating myself. Proposition 1 says, if I center my analysis on capitalized expected earnings alone, then proposition 1 replaces Gordon-Williams. Now what we're saying here, well, let me replace expected earnings capitalized, replace that with RIB, which is really, I have to introduce book value. And the way I do that, I know it has a negative weight because I want to be consistent with RIB. So the weight on book value is negative, and then this is what we end up with here. Now, later, very shortly, I'm doing okay here. Yeah, we can introduce, it's not really a RIB, so just listen to me. RIB is just a benchmark. It's really RIB plus background noise. And that's the model we're heading for. Am I clear? In other words, we remove steady state condition by introducing background information. Then we remove it. And that means now that it's really, model has been modified. It's really expected RIB at the future is a good estimate of equity value at that point. But today, maybe not, maybe. If we're not in a steady state, RIB is not going to work. So we have to be in a steady state. So we get to that, then we're done. But now, of course, keep in mind, concepts of accounting must mesh with equity valuation. Equity valuation must ultimately mesh and align with how do you forecast earnings? So that's what's lurking in the background now. This is the final sort of, or second to last ingredient. So this is what we should expect. So let's take our time here. Just look at this here. What do we expect if you want to forecast expected earnings? The first thing we expect is, of course, that the greater the current earnings, the greater the expected earnings. Earnings beget more earnings. Okay. We're forecasting earnings. DT has a negative sign. And of course, that we know too. If you pay dividends today, you're going to hurt future earnings. So we're going to have a negative sign. So that's so far so good. Now, what else do we know? Well, now we have to be a little bit sophisticated. If you invest and keep your dividends in retained earnings, that's sort of a capital expenditures, you expect more earnings in the future. Am I right? Does that work? You can check. It's common sense. And it shows up in textbooks sort of one way or another. And finally, if you control for that, book value has a negative sign. So we have we have four things here. They can be combined. So this is really, in some sense, the punchline here. If you want to use RIB and you start to think about how do you forecast expected earnings, which is a central piece of what you forecast, then you have earnings, dividends, retained earnings, change in retained earnings, and the book value itself. And the punchline, of course, is that this reflects conservative accounting, so does this, and that means if you have conservative accounting, then it has future earnings. So it's really quite remarkable that it actually works. I'm a little bit proud, but let me tell you, it takes time to do this, to juggle the balls. And again, just for sure that if you happen to read the paper and so forth, the math is not difficult. Some of you find that it's a little bit too much housekeeping. I don't want to do it. That's okay. But this is where you're heading. Now, ultimately, then, of course, you're going to have to do this without RIB. Okay. And that can actually, no, without, I'm sorry, PVED. Now, that can be done. But then you have to be, that escalates the math. All right. So then it turns out here that more general, other information can be put in background. It's also present on the right-hand side. Okay, so it's not quite, but the point is that what I can do is to say that expected earnings is some function of EDBT, and BT minus 1, 2, I want to, plus VT, other information, plus forecasting noise. And I forgot the parentheses here. So then if this is sort of regressive, or the very simplest possible model, if you've seen this other information stuff before, then you can get it. But notice here that the other information is expected to be zero way out in the future. So that means that the expected earnings are going to be RIB, determined by RIB. Am I clear? So just let me repeat the strategy. Let's assume that everything is steady state model. I can assume RIB. And that means that RIB determines the stock price. Once I have that, then I can give an M&M and whatever have you. Then I derive how do we forecast earnings. And then I'm saying here is that the real world is going to be more complicated. We have background information, other information. On average, the average information in the long run is going to be zero. So that means on the average in the long run, RIB will, on the average, determine expected price. Okay. And, but at any given point in time, things may be all over the place. So that's sort of a punchline here. So now I'm sort of done here. Excuse me, my voice is sort of gone here. So this is just the key thing here is that value depends upon accounting data. The specificity depends on the concept. If you want to talk a sort of big picture again here, if you want to talk about value determination, you must have concepts. And the question is how do we formalize the concepts? And that's what the paper is all about. And it really has to do with how to think about forecasting. So in the simplest possible model, I don't have book value. And then that is a very simple model and it's much better than Gordon Williams. It's just as easy. So then I keep that mathematical structure. And then we introduce, no, it's not book value expected earnings alone. It's also the current book value of a negative way. Then we put this in here. And all of this is doable because we have dividend policy relevancy. So I put this in red here. And that's why the proposition is important. We must be able to prove dividend policy relevance without introducing a payout ratio. Let me repeat that. M&M has no meaning if growth depends upon the payout and the payout is supposed to affect the growth is supposed to. So you have to neutralize that. And that's, again, what I like to think from your point of view. It's the takeaway of this paper. Look at the proposition carefully. There is no mathematical difficulty. And once you have that, you would never look back and do Gordon Williams. Gordon Williams is consistent with it, but you don't need it. But now we understand wealth distribution as a phenomena independent of having particular case. Okay. So the nice thing here is that we don't really, notice here, I don't talk about K any longer. I only talk about R and G. And the simplest model is RIV, R, and G fixed. So if R is fixed, G is fixed, it's really sort of, in some sense, it neutralizes the growth from a point of view of a dividend policy. And it's actually quite sophisticated. So the paper actually, you can do the M&M as an exercise, and you find out, oh no, yeah, it works. And what I want you to do, if you really want to look at it, if you have RIV, if you look at it properly, you have M&M, you have dividend policy relevance. Just look at it and do the analysis. And I think I have it a little bit in my slides here. So that's sort of a totality here. And from your point of view, what is worthwhile from your point of view? Well, I'm thinking about from a point of view of teaching equity valuation. And you have an audience of accountants. So this would not work for finance people. If you want to lose eye contact with finance people, talk about the errors in M&M, then you lose eye contact. I tried it. They just don't want to hear about it. They do not want to hear about it. And actually, you could actually see that the reason finance people have to introduce cash flows is to finesse the whole issue, because they cannot deal with earnings, because then you get into the time value of earnings, and then you have to start to explain that. So from that point of view, it's a little bit of an angle, but you want to teach the basic thing is I have something better than Gordon Williams. This is very simple. And keep in mind that it's a complete theory, so you can derive PVD. Otherwise, it would be useless. In other words, it's the dynamics, the equity valuation. Then you move on to RIV, and then you have to nail it down very carefully. And once you have that, then you move on and you say, we have equity valuation here. Oh, RIV is equity valuation. But we have concepts in the background. So that means we have, if you want to forecast earnings, This is what you have to put on the table: current earnings, current dividends, retained earnings, and book value. And all of that is intuitive. Nobody says, oh, I don't believe this. What's going on? No, this is how it is. And finally, you say, we live in a very messy world. There are all sorts of other information that influences the forecasting of earnings. And companies have current losses, non-recurring items, and sales growth and whatever, and you can actually factor these things in here, and then you get sort of much more precise things, and you can sort of get what you want. But once you have that, you break what you have, but you keep the underlying action, M&M, and also the fact that the RIV may not, no valuation model is going to really hold at any given point in time. The question is, what can I expect to work on the average? And that's a nice way, in my mind, to think about this is how RIV should be taught. It's not going to work at all. And then you can see here is that what you have in the literature regarding RIV is not the right way of going. You know, that you have to come to grips with that the book value is negative. And that's what you need to emphasize. It's powerful. It makes sense. Because it does not preclude that book value does, of course, have an impact upon expected earnings. Am I clear? It's incomplete, but that's lurking in the background. So it's sort of a little bit paradoxical because in the actual RIV expression in the textbook, you have book value as a valuation anchor, and it sort of might make you uncomfortable to then say, oh, valuation anchor, oh, it has a negative coefficient. But you see, you have to keep in mind that RIV centers really on expected earnings. And the book value is the appropriate adjustment of the fact that there's more to life than just earnings and dividends. And that's what you have there. But you can keep your dividends and so forth. So now my voice is gone here, and I think I've been sticking to my schedule. And now I'm ready for questions.
Thank you very much, David, for James, also for your contribution and your effort. It's really an excellent presentation. Now, if anyone have any questions, you can open your mic and ask your question. Salman?
Hi, thanks, Jim. This was really interesting. Just a suggestion, if you mentioned that it fits the data, and it would be amazing to kind of see that in some form. So just a suggestion to try to test this empirically.
How you test it?
Yeah, this seems like a really interesting, contribution.
Yes,
So
but I mean, the thing, you see, there's a trap, and that means that you move to regression models. That's not going to work. It just does not work, and it never has worked and never will work. However, what you can do is to take the pieces and control. And from that point of view, just look at the RIV itself. It's very interesting. If you control for EP, it has the implications about forward EP and R and dividends. It has implications for the market to book and so forth. I mean, that you could do it in the simplest possible way and say the Ball and Brown thing. Control for, so let's say that we have Ball and Brown firms, and you have Ball and Brown. Let's assume that expected earnings at the beginning of a period are much less than the expected earnings at the end of the period. Okay? Now what you can do is to look at the loss firm and compare that with the profit firms. Which of the two groups will have a higher return? Am I clear? Look at companies with big increases in expected earnings. Partition the group into companies with losses or poor earnings versus good earnings. The question of which group has the higher return is going to be the loss firms. It's a wonderful thing. Expected earnings are going up. Good news. And I'm also putting in losses. So that means the book value is much less. So future expenses are also going to be much less. So these companies have very high returns. There's no drama to it. So that's sort of how you test things. Look at it from the same thing is you can take increases in retained earnings, controlling for something. Does that influence expected earnings? The answer is yes. So that's what I'm saying is that if you look at the pieces here, the pieces are assertions about how the pieces fit together in the real world. You can check that out. But you don't do that via regression models. You just do it by groupings and stuff like that. Am I clear? So I don't think this is ever going to happen given the state of how we do business and so forth, and people put in regressions and fixed effects and so forth. That would destroy everything. So what I'm saying is that you probably won't, probably nobody really cares about this from an empirical point of view. However, from your point of view, if you teach FSA, the message is that you can do two things. One first thing you do is to remove Gordon Williams and check up on the replacement. And the second thing you say here is that let me now introduce book values, and you do that via RIV. And then you get the valuation framework. So it's RIV, and then you get dividend policy relevancy, and then you get the forecasting of earnings. So the forecasting of earnings, of course, there's an endless number of things you can do, but it doesn't fit with the current literature. That it doesn't do. I mean, in general, if you look at what I'm doing here, it doesn't really fit with the current literature. It's a different way of thinking because I'm not really looking at from that the mathematical representation is the sort of something which is an empirical representation. The proposition in its two versions here applied are not empirical propositions. RIV does not explain current book value, current market values. RIV does not explain, but what you can do is to say, if I have a RIV, what is the forecasting going to look like? And then you could say in the real world, it's going to be much more complicated because there are an endless number of things that lurk in the background. So that's sort of my comment. In other words, if you look at the literature on RIV applications and risk and so forth, in my mind, is completely useless and garbage, basically. But that's just me. People still get, publications and citations, and it's been a nice chain letter, You take RIV and you do this and that, and then you look at profitability and you take, fixed effects and you do this and that, and then everything works out. But this is not at all how I think about it. But you can also start to do work on R and see if R correlates with measures of risk. So, for example, the simplest possible thing I have, look what I have, the simplest possible thing is, let's assume you estimate R by taking expected earnings and divide by the average of book value and price. What do you end up with? Well, you're going to end up with an R. And this is going to, in general, looks very reasonable. Now the question, if you start to do groupings, or the R's, if you take then, here are all these firms, they are high risk firms, are they going to have higher R when you put R equal to G? Then, of course, you might say here is this that I only want to do that for firms that pay dividends and so forth. So there are things you can do. And what I'm saying is once you do it that way, you're changing the ball game. Because you're really thinking about financial statement analysis, not as an academic exercise. It's really an exercise that helps you to explicate the real world in the classroom. So that's sort of the objective with the paper. The difficulty, of course, is that, and that's sort of where I hope I contributed, is to get order out of the problem. In other words, simplicity is a prerequisite. The question is how do you do what you want to do when the math is simple and yet you address the question at hand? So that in my mind, it's a lot of work, and it's been a lot of work. And if you really do it correctly, as it were, as I indicated, you really have to get rid of PBED and start to do with more basic things. It's sort of an error in the literature, PBED, but that's sort of what I stick to. But that's sort of a big problem we have in all of finance, equity valuation or not. How do you deal with equity valuation when you don't have PBED? What is the natural starting point? Well, it turns out that has an answer, but then the question is how do you mix that with analytics? So that's sort of what I can say at this point. But I won't write that up. I'm too. So that's it. Yeah.
Good. Professor Paul, you have a question?
Yeah. Just one more. Jim, so you spent a lot of time talking about steady state.
Yeah.
But then a few moments ago, when you were answering Salman's question, you used the example of a firm that's had low or negative earnings. So clearly, that's not a steady state firm, right?
No.
So this would hold even though you use the
Organizations,
steady state to derive it, but this would hold even outside of the steady state. Is that right?
Yeah. What I'm saying is the RIV model says, no, you can think about it. Yes, of course. What I'm saying is that the RIV model can be exploited to explain why you expect earnings to be negative, to have a negative load factor. But it's a very, very, very simple, it's sort of obvious. But if you want to formalize it, you can use RIV. You see what I'm saying? I mean, you can put in background noise and whatever have you. But it comes down to the fact that, you see, it's a very complicated world, because in my analysis, the centrality is expected earnings, expected earnings, expected earnings. Some people don't like that. People want to say, oh, it's realized earnings, because that's what accounting doesn't really revolve around expected earnings. And my big insight, which some people don't like, my big insight, Jim Ohlson, for myself, is that earnings are really of no particular key relevance unless it bears on future expected earnings. So you see that basically what I'm saying here is that when you have expected earnings 2 years down the line, 3 years down the line, and for that purpose, then earnings would be relevant. So that can be done in my framework. But you see, we don't want to overdo the math. There's a danger with all parametric models. So you can sort of see how I do it. What I'm saying is, as a first cut, if you happen to have a RIV, and you have to forecast expected earnings, what would be on the right-hand side? I'm not saying that's the model you should use when you forecast expected earnings. That depends upon sales and a million of other things. So what I'm saying is it's a question of organizing your thinking around E, D, and B. So we get back to basics. This is a paper about, my paper here is a paper about, we have earnings, we have dividends, we have book value. How do these variables fit into equity valuation? You could say, I don't care, and that's fair enough. I'm not saying anything here is a road to riches. What I'm saying is, it's a question you can ask. How do earnings, dividends, and book value fit into equity valuation? And part of that is, how does it fit into forecasting earnings? So that's what we're at.
Professor Samir Trabolsi. Samir Trabolsi, can
Yeah, I'm coming.
Yeah, my final comment is that the way, if you ever want to read the paper, keep in mind what I want, the way I've been trying to write is that if it's only 15 pages, but only there has to be put into quotation mark. If you read the carefully paper twice, you will never forget it, even if you try to. That's how the paper is written. Even if you try to forget what's in the paper, you will not forget. And that's sort of a little bit why I put in this M&M is wrong. Yeah, it is wrong. And it's kind of interesting in my mind. If you care about what we're doing, Here's this Nobel Prize winning paper, and some people read it and says, it doesn't seem right. No, it is not right. It is obviously wrong. Well, how do you straighten it out? So some people
Yeah.
find that interesting. I don't think most people today would care one bit about that. So it's for a minority, of course.
Hi, Professor Ohlson. This is an amazing presentation. Samir Trabelsi with you. I really enjoy the presentation. Amazing job.
Thank you very much for commenting so favorably. Yeah, I hope people enjoy. I mean, it's obviously this paper cannot get published, but the
But
thing is,
my question is, my question is, I understand earnings is very important, and earnings, like the growth of future earnings, should be also embedded in any valuation model. But you're talking, and I'm thinking about those outliers that we always trim or winterize, right? And here I have in mind those distressed firm. They don't have earnings, right? They are really in bad shape, right? So does this apply to those? Are the star
I
firm?
mean, no. Once you get out of steady state, in some sense, it's sort of like macroeconomics or whatever have you. Anything can happen.
Okay.
I mean, it's sort of it's a peculiar thing because if you teach valuation, then people say that this is supposed to be helpful. Well, if you crank the formulas, usually you wail. And the question, so why are we doing this? So it's a very problematic thing, is because nobody says that you can come up with a model that values everything, because ultimately it depends upon the broader story. So that's sort of a problem we face. In other words, one reason people stay away from empirical research and equity valuation is that they get dismayed by the fact that there are too many balls that you can juggle. And instead, it's much easier than to take a structural problem and just check out if the load factor on the variable is positive or negative and so forth. This is not what you do here. So in other words, what this does is to ask questions. You familiar with the Magnificent Seven in the US? The stocks called Magnificent Seven?
Yeah.
Yeah. And the question is, how are they valued? They have very, very, very large forward Ps. What about their book values? They're very, very small. But that's exactly what the theory is saying it should be. So now you can sort of check into this. Am I clear?
Yeah.
Yeah. So that's sort of it. It's very, very hard. I mean, in other words, you could easily this paper is not the road to riches. So people could say, oh, what about cash flows? Yeah, I know. What about sales? That's sort of my favorite. I haven't mentioned the word sales. I haven't mentioned the word cash flows. It can be done, but you have to be very cautious because you got to have something in mind how it should work on average. Very difficult. But this can be checked too. And the formula analysis might help you to organize your thinking in terms of what you want to control for. So that's sort of evaluation in action in the real world. So this is sort of really what I'm doing here is I don't want to bore you, I repeat myself. It's sort of really supposed to help you. You do want to teach Gordon Grove, and I give you something much better. And you do want, and many people do want to teach RIB. And I'm giving you the right way of looking at it, the better way of looking at it. That's what you get, pragmatically. In my mind.
Are there other questions? If anyone have any questions, you can open your mic and ask your question. If you have any questions, you can open your mic and ask your question, please. Thank you very much, dear Professor James, also for your contribution and your effort. Thank you, everyone, joining us today, and thank you very much for taking the time to present it to us. It's been appreciated, dear Professor James, also.
Yeah, it's been my pleasure. Thank you for sitting in and or at least sort of paying some attention. Thank you.
Yeah, and I hope to see you soon in Egypt. You are very, very welcome.
Oh, thank you. Thank you.